Happy Thursday, everybody. I'm Niamki Buchanan, joined by my co host, Matt White. On today's episode, we're diving into a massive record breaking week for the economy. The S&P 500 and the NASDAQ have both just smashed all time highs on the back of a huge tech rebound and hopes for global stability over in the Middle East. We're also going to break down exactly what's driving these headlines, how the global supply chain directly impacts the cash in your wallet, and what strong bank earnings tell us about the everyday consumer. Let's get right to it on this episode of Road to Riches. All right, welcome back to this episode of Road to Riches, everybody. Of course, the thing that most people care about is going to be the fact that, yes, we in fact have gotten back in good graces with the stock market. Surprisingly, um, despite the fact that we've been at war, even though some people won't necessarily call it that specifically, for the last couple months, just about. Um, the stock markets have completely rebound. We're now up around 2% on the year, despite all of those global issues. Tech stocks have really led this rally. Don't get me wrong, partially due to AI and things like that. Especially when it comes to companies that make memory and hard drives. But even then, they've still seen a little bit of a uh, of a hard time. We've got an article here from the Wall Street Journal that goes into this a little bit more in depth. They report tech stocks power the S&P 500 and the Nasdaq to records. Surging tech stocks carried the S&P 500 and the Nasdaq Composite to new records on Wednesday, a milestone in major indexes rebound from war-fueled losses. Uh, Big gains came from Microsoft and Tesla, and the S&P rose 0.8% to just over $7,000, which is a great rally. Um, we've also seen massive increases in the Nasdaq, mostly for that same reason. When it comes to the FANG stocks, the Magnificent Seven, etc., those are really the large companies in both the Nasdaq and the S&P 500. S&P 500 is a bit more broad. The Nasdaq being an index fund of the top 100 tech stocks, specifically um, U.S. tech stocks, that is. So there's a lot of overlap in there, and it's good that we are finally seeing a return to normalcy somewhat, despite the fact that things are still a little bit up in the air with the peace agreement. As of the time of recording, of course, this is uh, Wednesday night on the 15th. Speaking of the 15th, today is tax day, everybody. So hopefully you actually got your taxes filed on time. If you're doing them the day of or after uh, you're actually listening to this episode, then it means that you're actually late. Let's hope that the IRS doesn't give you a penalty. If your accountant was smart, then they would have had you file for an extension, which can push you out, I believe, until either September or October. Uh,
I think October 15th.
yeah, there we go, October 15th. This is why I have a co-host, because I'm not smart. So speaking of my co-host, Um, I gave a pretty good general overview, I'd say, there, Matt. But what are your feelings on this situation when it comes to how these global interactions are playing into the stock market and the fact that we've bounced back very significantly?
Yeah, so I think there's actually quite a bit of knowledge here, and general lessons to be learned for anybody new, specifically new people going into the market. I think a lot of this, like the article says, the S&P reached an all-time high. The Nasdaq is on its longest winning streak since 21. Just going down the list, like you said, the Magnificent Seven is leading the charge, and even software companies like Intuit and ServiceNow, these companies at the beginning where they were experiencing stock downturns because, and a lot of that actually had to do with AI. And so it's just on a tangent real quick. It's kind of funny that the Magnificent Seven is doing so well, and also stocks like Intuit and ServiceNow are also doing well. Companies that have a lot to lose. by AI and the AI growth and quote unquote revolution. But moving on to the greater point, uh, all of this is due to the United States. All of this is due to the United States moving towards a peace deal with Iran, and it's particularly a lot of it is due to increasing hopes, especially because of the blockade that the United States set up around the Strait of Hormuz, and leading a lot of oil tankers to not be able to even pass through, including Iranian ones. Uh, and it's really starting to squeeze Iran towards a deal, and that actually has a lot to do with these stocks rising. To answer your question about what I think about everything, uh, like I said, the key lesson here is that uh, like you always say, time in the market will always beat timing the market. Um, and this is a perfect example. Markets go up, they go down. As McConaughey says in Wolf of Wall Street, sideways, round in circles. Nobody knows. Nobody has a crystal ball. Warren Buffett has been wrong a lot, just like he's been right a lot. Uh, Meaning that this is just a natural consequence of a growing market, and it is, as we've discussed in previous episodes, it would be a shame for people to start getting scared when the market did have its initial downturn, and start selling off. uh, and as Jim Cramer would say, sell, sell, sell. Well, that's not necessarily a good, that's not necessarily a good strategy, especially in hindsight, that we see here. And let's not pretend that this is new. I mean, this has happened time and time again. This is a recurring lesson, but it's a lesson that for some odd reason, I say for some reason, um, a rather short-sighted reason, people still seem oblivious to the possibility of market rebounds and things like that. Um, you know, it but there is but it's not like these stock rebounds are for no reason. Like we talked about, these AI stocks are going back up because of market enthusiasm that we're finally reaching a deal. Even oil stocks are going down a little bit, uh, after going up to 100 108 $110 a barrel. And even consumer spending is up. So if you look at Bank of America, they reported a 17% profit jump. Uh, and I believe that's year over year, um, although it might be month over month. And PNC Financial also posted strong earnings. They wasn't nearly as high as Bank of America, but they also had pretty strong earnings as well. And These big bank CEOs are pointing to the fact that there has been solid consumer spending that has backed their company's growth. Um, and so again, just 53 trading days ago, or 50 trading days. I think it was 53. Sometime in February. The market was really really down, and it was down because especially companies like Intuit were down because of AI is going to come and it's going to replace all the accountants. Um, and and also the Iran war. And what we're seeing now is a rebounding stock market. It's going back to normal. And what I would really like to see now is perhaps those gas prices go down a little bit. Uh, uh, but time will tell with that. Again, rambling a little bit, but the point is, guys, time in the market will always beat timing the market. You're just wait, just give it time, give these investments time. Again, because 53 days later, they may be back up where they were, or even above where they were as they are now. And so uh, I think things are, coming back to normal. Hopefully, we reach a deal with Iran. It looks like maybe we're getting pretty close to that. Time will tell with that, but that's the general lesson I think people should take away from this. And again, as far as what I think that it's all good news. I'm happy it happened, and going forward, let's hope the growth keeps going.
Yeah, of course. I mean, growth is always going to be a good thing. You talked a little bit about the financial sector and how banks that have recently reported earnings, at least as of the date of this article, um, have been doing very well. To be completely honest, that's somewhat of a surprise, given the fact that these banks do rely on trading and things like that of businesses, and because of the war, a lot of companies have had higher expenses recently. I mean, we have to be completely honest. I mean, especially like transportation companies or any type of manufacturer that does high volume and relies on trucks and things like that, they're starting to suffer a little bit from the higher gas prices, right? And things like that. And we're seeing it really all around, hitting kind of every sector more or less. That said, I think what some people don't quite understand or really know, maybe is a better way to put it, about banks is that many of them also offer services for businesses relating to commodities and hedging and things like that. And those are the areas where these banks really saw a lot of their revenue growth the last quarter, because companies were starting to. I mean, I've even got a company or client that is, who we're starting to look at hedging aluminum, for example. Even though it's not something that's directly affected by the war, these are things that we're starting to see cascading effects in other areas, and we're of course going to be able to get some additional NII, as we call it, or non-interest income from those transactions. Uh, as the war is winding down as well, we're starting to see more trade, more international trade come back up into effect as well. Shipping prices are going down, so I think that on top of the gains we've seen in the stock market, we're also going to start seeing gains in many other areas of the economy where prices for many different goods, not just gas and oil prices, are going to start coming down. And we're going to, of course, see a little bit less strain on our pockets, and that's going to be good for everybody. Of course, the best thing you can do is take that extra, for lack of a better term, cash that you have on hand now and put it back into some investment accounts, or savings account where you're getting a decent amount, like a high yield savings account, or maybe even a CD, which is a certificate of deposit, where you're going to be getting uh, an interest rate that's above inflation. At least that's the goal, is for it to be above inflation, and that all has to do with the interest rates, right? But speaking of interest rates, we actually did have some news come out from the Fed recently, that they think that at least for the foreseeable future, interest rates are going to stay the same, but we still anticipate a couple of rate cuts. So after every meeting, a couple of weeks later, the Fed will release their minutes, which isn't a direct transcript necessarily, but it's somewhat of a highlighted uh, breakdown, or
What
a
they talked
list
about.
basically, right, of what they talked about at their meeting in the FOMC. That's where our next story comes from, actually. So let's go ahead and throw that up on the screen here. Fed officials still foresee rate cut this year despite war impacts. Minutes show. I believe they're pricing in two uh, rate cuts of 25 bips, which is 0.25%. Right now, the target rate is 3.5 to 3.75%. So we could see that come down legitimately sometime this year. Timing depended on external factors, right?
Right.
Because, of course, as we've said before, they look at the interest rate, or not the interest rates, they look at the inflation rates, they look at the PCI and PCE indexes, they look at the macro economy as a whole, the supply of money, even the velocity of money. In some cases, they'll take a look at velocity of money, essentially being how quickly money circulates in a community and goes from one person to the next. Um, the idea behind that, of course, is that if people are hoarding their wealth, then less of it is being spent, is going around, and therefore prices are going to be affected by that, right? Um, so the article here, let's see. Federal Reserve officials at their March meeting still expected to lower interest rates this year, even with a high level of uncertainty from the Iran war and tariffs, according to minutes released Wednesday. Same thing as we've been saying previously, right? Policymakers said they need to remain nimble as they weighed the impact the war had on inflation, which continued to hold above the Fed's target. It does actually show what that target is right here. Fed's targeting 2%. This is something that is kind of standard for modern economic times. We want inflation to be about 2% because that we consider that to be a good balance between growth and stability. Growth in this case meaning prices growing, things getting more expensive. Um, I think that we should have maybe a little bit more of a discussion about inflation and why it's good, quote unquote, from an economic sense. Matt, of course, your degree is in economics, so you probably know this a little bit better than I do. So could you go ahead and explain that a little bit for us?
Right. So, well, when you say, inflation is good, I don't want to be a consultant about it, but it depends on the situation. But generally speaking, uh, generally speaking, the reason why the Fed goes at that 2% and wants a little bit of inflation is because uh, well, the official reason, and the reason that a lot of people say without having a deeper discussion on, the ethics and things behind it, is they want to protect against a collapse of the currency, essentially. So, it's sort of for the same reason that they don't that they raise rates when the inflation rate goes up. So ultimately, in economics, you have this principle of a certain amount of money chasing a certain amount of goods, and the certain amount of goods, let's just assume that it stays constant. The definition of inflation is when that money supply begins to go up, and now you have more money chasing the same amount of goods. And so ultimately what happens? Well, we go to our handy dandy supply and demand graph and say that, hey, uh, I think that price is gonna go up. um, when the amount of money, aka demand, when the amount of money that people are willing to pay for something uh, it increases because they have more money, the price increases, and so there you have inflation. More money chasing the same amount of goods, and this is why we have such a problem with economists saying. Uh, uh, Specifically, John Maynard Keynes, he had this idea back in late 1920s, early 1930s, a British economist who had the idea that you could simply stray away from supply side economics, and that the economy was an engine, and all the engine needed was a little bit of fuel, petrol, as the British call it. It's incorrect, but that's what they call it. um, and that'll get the economy going. And as I just discussed, the reason that that is not entirely correct and can actually lead to something called hyperinflation, which is a little bit of what the world experienced in the 1930s when we took on this ideology of Sir Maynard Keynes, is when the when the country, take your pick, like in the United States, for example, when the United States government starts giving people government jobs, starts employing everybody, particularly when the war started, but specifically during the height of the Great Depression, so 1932, 1933, and 34, what you have now is a bunch of people with a lot of money, but the goods have not changed at all. So what do you think the price of the goods are going to do? They're going to go up. And has even a different effect when you consider that there's only a couple ways the government can raise money to start paying people, because the government is not it's not necessarily a business. It doesn't produce anything. It taxes, and that's its only revenue stream. Um, so, with that in mind, the government can either tax more to gain the revenue, which is just a direct tax on aggregate supply. They can print money, which will ultimately cause inflation. Again, more money chasing the same amount of goods. Um, or they can just well, no, those are the two options, but they have the same effect. They take away from aggregate supply because now the supplier's money is worth less. And so what do they have to do to their supplies? Well, they have to charge more. What do they have to do to their products? They have to charge more. And so, all of that to say, and it was probably more complicated than I need to make it, because there's so much to say about it and the absurdity of this principle known as Keynesian economics. Um, but but it's ridiculous to say that if we just put more money into the economy, it'll work more. That's an absurd statement, and these people who call themselves economists should know better. Um, and some of them do, but they have ulterior motives, which is a discussion for another time. But anyway, that is inflation in a nutshell: more money chasing the same amount of goods. And the opposite is true for deflation: more goods chasing the same amount of money. The Fed likes to keep it at 2% uh, the Fed likes to keep it at 2% because their excuse is that they are trying to predict the growth of the economy. What they're essentially saying is, we're predicting that the economy is going to grow at least 2% per quarter, and we're going to keep inflation at 2% to offset that growth. So that way we don't have a dramatic deflationary period or inflationary period. That is the official story as to why they go for that 2%, and the reason why they look at not they don't look at the basket of goods like we do, the consumer price index. What they look at is the consumer expenditures index, which is how much people is not necessarily the price of things, but how much people are paying for the things, because the two are not necessarily the same. And they also look at what happens when you take volatile goods out of that basket. So, energy. What happens when you take energy out of that basket? And we've had that discussion before, where actually inflation is doing as good as it's done since 2021, if you take out the volatile goods. And so, again, that's the official story, but we can have the discussion on why that story may have ulterior motives later. But that is the official story. They're trying to predict the growth of the economy, and by also setting an inflation rate at 2%, the currency will keep up with the supply of goods. So that way, suppliers don't all of a sudden have to charge less for their goods because there's less money in the economy, and buyers don't all of a sudden have to pay way more for their goods because there's much more money in the economy. Uh, and so sorry, I don't mean to take the spotlight from you there, Nyanki, but um, that's the inflation story.
No, you're fine to take the spotlight because the theoretical side of things is a bit more your wheelhouse than mine. That said, I'm gonna need you to not mention Canes anymore because my cortisol spikes whenever you do.
It gets worrisome there. We
Yeah.
start looking over our shoulders for bulls and bears.
Oh man, I just don't understand how people can legitimately think that he is good or was at least was good at what he did. I mean, ooh, that's a whole nightmare. There's a reason why we don't believe in trickle down economics anymore.
It,
Well, some
you,
people still do, but
you know what it is? It's socialism that disguised itself as economics. I mean, again, like I said, the whole thing is asinine. It doesn't make any sense. It doesn't work for a normal business. You can't
oh yeah,
if the business's business model is failing, and you say, oh well, let's give it $2 million and that'll help. No, it won't. Its business model is failing. How long is it going to take that business to come back and ask you for more money because it blew through it all because its business cycle is bad. Um,
of course
and
you know about this, given what we were talking about earlier
Oh yeah, well,
today.
but it's the same principle, but on a national scale. You can't just throw money at the economy and then again. And the reason I'm a little bit passionate about it is because it was one of my collegiate papers that I wrote. Is that what happened in the United States? It got so bad that we had ration cards before, during, and even a little bit after the war. Uh, and we had the Tennessee Valley Authority that promised the even the at the height of the Great Depression we had the Hoover Dam, of course constructed finished under the uh, presidency of Roosevelt, but it started during Hoover's administration. Um, that promise it gave a lot of people jobs. It promised to kind of help the United States out of the depression, and it didn't. It just straight didn't. And if you talk to people who actually lived at that time, if you actually look at the historical documents that went through the economic data of that time, you start to find out that the currency the currency initially went through a massive deflationary period, followed by a massive inflationary period. And no, you can't just throw money at the economy and expect it to grow. You have to stimulate supply before you start stimulating demand. And I thought this was common knowledge, but evidently not.
Well, I mean, the whole stimulate demand before you stimulate supply thing is why communism will never work. I mean, without prices, you can't actually know what people want, nor can you give a real incentive for people to produce anything. I mean, it's a crazy argument, but I mean, we can talk about communism. We can talk about the Great Depression for hours. I mean, like you said, yes, the economy. People don't understand this, right? At the end of the Great Depression or towards the end of it, the US economy was actually in a recovery period, and the money that the government threw at this situation through the Works Progress Administration and through all these other things was actually hurting the average person by, as you said, causing that additional inflation. I mean, the jobs that were created from these things were seemingly good, right? But because they were number one temporary projects, but number two stemming from a place of not having any real, more or less value for society, there was nothing that was going to come out of them afterwards. We want to talk about all these things about, oh, Roosevelt did this, Roosevelt did that. There's a reason why his New Deal got him 3 terms as president. No, what the actual thing is that we didn't see the real full true recovery of the economy until World War II, because then we had actual value being created by these manufacturers. That's actually what healed the economy, but that's a conversation for a different time. We do want to talk about healing the economy, though, but that's not really what's happening right now, unfortunately. Our third article here is another article by CNBC. Homebuyer mortgage demand drops annually for the first time in over a year as war fuels uncertainty.
Yeah,
We
I'm sure
talk
that's
about
what's
housing.
fueling.
What were you saying, Matt?
I'm sure that's what's fueling it.
Yeah, yeah. What's I can't. People our age can barely afford rent, right? But
Right.
what's happening over in Iran is making sure we can't buy houses. It's not like
I
this
mean, it's
hasn't
certainly
been a
not
problem for
helping,
literally
but
years.
right. It's certainly not helping, but but it's totally not because the median home price is 5 times as high as the median income. It's totally not because
Thank
of
you,
that.
thank you. Home values have shot through the roof, but wages have stayed relatively flat. I mean, especially once you factor in inflation, most people are making less than they did or than we would have, that is 50 years ago. I mean, the purchasing power of the average American is horrible. It's horrible. There's a reason why things are so expensive right now. This article, as wrong as the premise may be, does have some good information in here, right? Mortgage rates finally ticked a little bit higher, a tiny bit lower, excuse me, a little bit lower last week, but not enough to help the ailing mortgage market. Economic uncertainty fueled by the Iran war, among other things, is keeping rates elevated and home buyers on the fence. As a result, total mortgage application volume fell 0.8% last week compared with the previous week, according to the Mortgage Bankers Association seasonally adjusted index. Now, one thing that I do want to say before we actually talk about this a little bit more in depth is how small, rather how short, the length of the survey is. While we do have significant amounts of data for mortgage applications on a week by week basis, that quick turnaround is not necessarily effective to gauge the true interest in buying houses. For whatever reason, we could just have a down week. This may be one of those things, but given the larger economy and macroeconomic scale, I don't necessarily think that's the case. Um, the reason why I say that is because uh, although I don't work on the mortgage side of things, I do like to keep up at least partly with mortgage rates and things like that. Um, Over the last few weeks, we have actually been seeing mortgage rates steadily increase. Um, they had been coming down up until the start of the war, and a couple of weeks into it, they continued to go down. Once costs started rising kind of across the board, and there was some uncertainty, and things were changing in the government with the Fed, etc. The banks wanted to be a little bit more conservative, and they started raising rates a little bit more. And like I said, that's continued for the last few weeks. Last week, however, mortgage rates actually went down for the first time in, I think, about a month and a half to 2 months, something like that, which is a good thing for people who are looking to get into the home market. Um, However, the way that things are right now, it doesn't matter on a large scale anyway. As we see here, mortgage applications are down. Um, I can't remember if we've shown the graphic or not, but I know we've talked on this show previously about how there are so many more people selling homes than there are buying homes. We've talked about how the average age for a person buying a home, or actually, I think it's the median age. One of those two is like 57 years old, where and it's been steadily creeping up for the last 30, 40, 50 years, which is not a good thing, especially for younger people. But that's of course why we're coming into a massive transfer of wealth in the next 10 to 20 years, because homes are going to start being inherited, passed down, assuming that they don't get taxed into oblivion through the estate tax, and now no one has anything. Thank you, government. that that said, oh, it actually does show it in here. Um, I, I probably just should have read it, but when I said that mortgage rates did go down a little bit, it shows it in here. It says they decrease from 6.51% to 6.57. So yes, they did decrease a little bit. Um, that said, though, this continues to be just a good economic indicator of what we see in the larger economy. Home sales and home prices have kind of always been that, given the fact that it is a staple good that everyone needs, right, to some degree. So
Hmm.
we can generally assume that if homes are selling, then people are in a good economic position. Homes are not selling, people are not in a good economic position.
Right.
On the flip side, there's also a balancing act with it, right? Because if homes are a massive amount of homes are on the market, well, people aren't doing too well, you know. But if there are only a few homes on the market, then that could be a sign that people are doing great, and they can afford to keep their homes. But it can also be a sign that there is an underlying issue, and homes aren't being constructed, for example.
Right.
So when we have these conversations, we have to look at more than just one or two sets of numbers. And
Hmm.
I think that that's one of the good things about our show, where we continually talk about the same or similar targets or topics, but we attack them from different angles. And so we can, over time, get a large picture of the macroeconomic landscape here.
Right. Well, okay. Well, and this is interesting because I'm interested to see what you have to say then about this inventory stagflation or stagnation rather, if you will, um, of houses where we see now 31% of listings are now on the market for over 6 weeks, right? And your earlier point, if people are not buying homes, which are undoubtedly incredibly necessary, at least a roof, we can agree on that. um, well, what about the banks reporting their high profits, and which, by the way, it's not just it does actually have something to do with consumer spending. Banks actually make more money the more deposits they have. They basically make no margin with loans. I think their credit spread is something on average like 2.5%. So, with all that being said, uh, so what are your thoughts on those two conflicting, or maybe not conflicting, but certainly they're they're indicating different things a little bit, I think. What are your thoughts on those two?
Yeah, I mean, like you said, it is somewhat conflicting, right? Because if banks are doing so well, then we would assume that means that there are lots of dollars being lent, right? Um, but as I briefly alluded to earlier when talking about the commodity hedging, or just mentioning it in passing, the reason banks are doing so well right now is not because of the amount of money that they're lending. Like you said, average spreads are somewhere around 2.5%. I was reviewing a couple of deals earlier today. Um, I think simply because of the lack of credit worthiness of this business, um, and the fact that they're taking on new debt, we were able to push our spread a little bit. actually
Hmm.
up to 400 bips, 4%.
Right.
But previously, we were at that 2.5 level, and even on some of the debt that we're keeping with them, we're still at that 2.5% level. So that's one thing, right? Is banks get to be selective with their clients and increase their margins in some ways through that process. Additionally, there's all the other services that we offer, right? We get fee income for a line of credit that's unused, for example. We get origination fees for opening up a whatever lending product it is, line of credit, term loan, uh, specific advance facility. Some people call it a guidance line. I think that's a stupid name because at least specific advance facility actually explains a little bit more what it's actually doing. Um,
Right.
that's excuse me. That's not a conversation for this podcast, though. I think that gets a little bit too into the realm of banking rather
Right.
than personal finance. Um, that said, I mean, yeah, there are plenty of ways that banks make money that can bolster their balance sheets. So that's one thing. But even outside of that, when we look at the fact that there are so many more houses on the market, when the number of buyers is steadily decreasing, when home prices themselves have continued to decline over the last few months, when uh, homes are sitting on the market for months at a time instead of typically the 2 to 3 weeks that they're on the market before they get an executed
Hmm.
contract, right? So this all goes to show that number one, homes are overinflated, right? The cost of homes is simply too high for a
Right.
variety of reasons. Um, Secondly, it shows that many people are discouraged from the prospect of buying a home. I saw a survey last week, which is why I don't remember exactly what the number was, but it said that there are a significant portion of people under 30 who have just completely given up on the idea of ever buying a home, of ever owning their home, right?
You
And
hate to
and
hear
that's a
that.
that's a bad thing
Right.
for not only those people but for the economy as a whole. It's a bad thing for our generations and eventually our children. Having no place that they can really call home and set their roots down. Um, all these things kind of culminate to a larger problem, which is generally that things cost too much and people don't make enough money. We've
Right.
talked we've talked previously about purchasing power and inflation and how it's gotten so bad over the last 50 years. That's just the case. I mean, unfortunately, that it is what it is, right?
Those are the facts. Yeah.
Wages have stagnated so much that now I believe like the average person's salary is somewhere around like 36, I believe, $1,000 right now.
Hmm.
Um, and the amount that we can get with that is like 5 times less than the equivalent salary of 1970. So we have these stratifications for people, right? Lower class, lower middle class, upper class, right? And although there's no real hard limit on what constitutes a specific class, because it's all kind of a nebulous topic that no one really sets and agrees on, but it's still generally seen from most people that or most institutions that actually do give numbers for these things. If you're not individually making six figures, not as a household, but individually making six figures, you are unlikely to ever even make it into the middle class.
Hmm.
And that's such a problem, given, like I
Right.
said, average salary is somewhere around $36,000. The fact that the availability of white collar jobs for new graduates is diminishing greatly. the fact that people are staying in their homes longer, people are staying in their jobs longer, not moving out of roles that entry level individuals can take. Um, it's it's a it's just a big mess right now, and there's no easy solution because unfortunately our economic situation right now is one that I think you do have to target the symptoms, at
Mhm.
least at first. Normally I say, oh, well, go to the source. Well, in a situation like this, so many things are the source that you can't fix the problem until you alleviate some of the stress that are on people so that way they can spread out and get to opportunities to build themselves up. And that way we'll have the resources and the ability to later on fix the actual problem itself.
Let me proffer a hypothesis. Let's about it, because this is what I think about it. And let's see if you have anything to add about it. Uh, because when I asked that question, I actually thought you might end up saying this, and I think you did a little bit, which is, well, yeah, both of those things can be true at the same time. It's just that all of the people with money are also all of the people with the houses.
Yeah.
And so, yeah, banks are experiencing crazy profit. It's amazing. But as it turns out, that isn't the people who we would like to think it is. It's the boomer class.
Yeah.
It's the older generation, like you mentioned before. It's the 57-year-olds who own or that's just the median age. It's the boomers who own all of the houses.
Mhm.
And that's where all their money is. That's where all of their and you've seen it. I'll tell you right now, I've seen way more of it than I would like to cash out equity loans, which, for people who don't know what those are, it is people who have a house free and clear, meaning that they don't owe anything on it. They own it free and clear. They have the title in hand, um, and they want to get equity on it. And the thing about that is that their property value has risen over time. That's the only reason they would do this, is if their property value rises over time. And now they have that money to go out and buy another rental property. And again, what we're seeing with this housing market trend is that it's fake. That it's, your house is not, it may appraise for that, but it's not selling for that, and that's what matters. So in other words, it's fake. Uh, and and if the bank had to go and get your house because you can't make payments on it, the bank would, I mean, correct me if I'm wrong, Yankee, the bank would not be able to acquire even 80% of that appraised value. And we're seeing the proof right here. They're not selling. And so that's my hypothesis on it. And again, like I said, I want to see if you agree somewhat, or if there's things I'm missing there. But that's kind of what I was thinking when I'm like, well, all the people with the houses also have all the money, so of course, you know.
Yeah, yeah. I mean, you are right. Yeah, the people with the houses are the people with the money. Like you, and something else, right? You don't necessarily have to get a cash out refinance or pull another mortgage or anything like that on a home to be able to get a second one. The reason why you would do that if your goal was to buy another home or a rental property or something like that is just so you could have enough for the down payment, right? Because at the end of the day, the bank is going to look at your assets and they're going to see that you have a home already, and they're going to see that it appraises for, we'll say, $1 million, right? If your home appraises for $1 million and and you're looking at another home, you have the down payment for it. Well, then they're just going to say, all right, we'll just take out a second lien on your current property, assuming you're not
Mhm.
in a homestead state, which is actually another reason why you might want to do a cash out, because if you are in a homestead state, then you can't put your house up, your personal home up as collateral. So you would have to do that cash out so you can pull out that equity, like you said, and use it to get a second home. Um, if you're not in a homestead state, like I said, they'll just take your house as collateral. You won't have to worry about any of that. But those types of transactions don't count as mortgages. So
Right.
these this drop in applications that we're seeing, for all we know, the same number of homes may be bought and sold. They're just not being bought by people that need to get a mortgage.
Hmm.
And the people that need to get a mortgage typically are the younger people or the middle-aged people that don't have a significant portion of liquid assets, things like that, right? I mean, imagine if you already have three or four homes, one of which is your primary residence, your homestead, and then you have two or three separate. And you say, "Hey, I want to go buy another." And I have enough cash for the down payment in my hand, and I'm just going to put up the rest of my homes as collateral. Bank's going to say, "All right, great. How much do you want?"
Hmm.
You know? And that's one thing that we're seeing, right? Or if you say, "Well, hey, I just want to pull the equity out of one of my homes to be able to buy another one, and I'm gonna get seller financing, for example, and that way you don't even have a mortgage, right? You're just getting cash out on the home that you already have. You're taking a different type of loan. So um, there was something else that I wanted to say about this topic. It
Well,
really doesn't matter now anyway.
I did want to add before we go, because we're running up on our limit here, but it's really important. Again, uh, I want to be clear. I don't actually think that it's the bank's fault. I don't even think that it's the big bank's fault here, even though we're talking about the same people who were pretty much responsible for the '08 financial crisis. We're not even. I'm not even blaming them. Because can you blame them? Are they supposed to say no? To no, we will not give you. We will not do this, and make a quick 2.5-3% spread on this. No, we will not.
You know, the
Okay.
funny thing with that though is, even if you did have a bank that said we want to act a little ideologically and cater to the younger people, they would be in violation of federal fair lending laws. So
Exactly.
as a bank, you literally cannot legally do the types of things that would benefit younger generations.
Right. You can. It's yeah. Again, exactly. It's against fair lending law and regulation, which is another thing for another time. But my main point actually is who I'm blaming. Who I'm blaming is who I'm blaming is uh, the people who have all of these houses who refuse to come down on their prices. They are stubborn, clearly, due to looking at the market. The article says, the Wall Street, it's right there in the Wall Street Journal article, they are not moving. And I've seen it, you've seen it. They are really not moving. I've seen
Yeah, there's
properties on
there's
the
a lot
market.
of memes about it.
Right. I've seen properties on the market for 18 months and they haven't moved an inch. Maximum they've moved 7%. And because of these equity lines, these old homeowners are not in a hurry to sell their houses. But all that being said, the point I want to make is this: uh, the the more and more you look at how our tax system is structured, the more and more you look at how it incentivizes and disincentivizes certain behaviors. Because again, Let's not pretend that the government doesn't engage in this. They do, in fact, engage in incentivization and disincentivization by policy. And in this case, what did we do in the 1970s? Well, we started to incorporate real estate tax breaks. You can now depreciate a lot more. You can now depreciate a lot more. You can start saving. You can start buying real estate and immediately depreciating it on your tax returns. You can take that tax benefit. What did we also do? We also raised the capital gains tax, short-term capital gains. We also raised the estate. We also raised various other taxes that incentivize investment. What is incorporating depreciation do? All that does is incentivize people to buy property and then sit on it. They're not investing anything. What they're doing is they're buying property and they're sitting on it. Why? Because they can continue to renovate it. They can continue to depreciate it. They can continue to earn rental income on it that they can just expense away. And that is why we are in the current situation we are in. I think that all of this uh, would have never happened. And by the way, it didn't ever happen. Let's not pretend that this couldn't have happened earlier. It didn't happen because we didn't have those tax breaks on the books, and we didn't um, punish people for example, wanted to make money by short-term investing, day trading, who wanted to do other things like that. And then we started taxing them, and again disincentivizing people from investment. And this caused inflation. And what does inflation do? Well, it at the end of the day, inflation disincentivizes saving. And what are savings? Savings go into banks, and banks ultimately make more money by deposits, like I mentioned before, than they do loans. And the way they make money on deposits is that they loan that money out. So all of that to say we are in this situation right now because of our tax system, because of what the government incentivizes and disincentivizes. And let's not pretend that that's not the case. Um, the way we should go about this is, like you said, start looking into giving some short-term relief to the younger people who are experiencing quite honestly, in some metrics, a financial a squeeze like we haven't experienced since the Great Depression. But we also need to look at some long-term solutions and start changing the tax code fundamentally to start encouraging saving and investment.
Yeah, I'm with you. I'm with you 100% on that. But that's a political discussion rather than an economic one, for the simple fact that as soon as we try to get people that actually want to do things right and help people out in Congress, everyone else steps in and says no.
Right. It- yeah. Just you have to be on the lookout for some of these financial trends, and you just maybe go in now in the market and start saying, hey, 20% lower and I'll buy it right now, or 25%. I'm I mean, really, at this point, what's the worst that can happen, right? Most likely the house has been on the market for 6 weeks. Um, and so I know from where I live, I've seen a lot more houses for sale. And I'm sure it's the same in DFW, maybe, or at least the suburbs. Um, and people just need to watch the market, stay in tune, like you always say, time in the market rather than timing the market. Be on the lookout for some good deals. um, and yeah, just be aware of these financial topics, because they can really save you in the long run and give you an edge over people who maybe aren't as informed, or maybe you can teach them to make sure everybody's informed. A rising tide rises all boats.
Yep. Yep. That's why it's good to watch this podcast so you can keep up. But that does it for this week's episode of Road to Riches. To quickly recap, tech resilience and geopolitical optimism have pushed the market to new highs. And despite all the noise on your timeline, strong consumer spending proves the foundational economy is actually doing fairly well. The biggest lesson from today is to ignore the doom scrolling, ignore the people trying to push you in one direction. We maybe next week, but also recently you did mention a little bit with the pattern day trading. Actually, the SEC has very recently rescinded the minimum account size to do that, and people are going to try to sell you different products and things like that to try and get you into it. Don't believe the hype. Day trading is a horrible thing. I lost a lot of money doing it. Uh, that said, stick to your long term investing strategy and let your time horizon work for you. If you got value out of today's breakdown, please make sure to hit that subscribe button and like the video. We also want to hear from you as well, so please drop a comment. There's been a one guy who's been fairly consistently commenting, and we really do appreciate it. Um, to let It lets us know that our message means something to you all who are listening. Um, yeah. And you might even get featured on next week's show, depending on what your comment is. So thanks for tuning in. Stay focused on your goals. New episodes come out every Thursday, and we will see you back next week.